Chapter 4, Part 1, Accounting Changes, Discontinued Operations, and Other Comprehensive Income. Thought I would cover this first so you have a better understanding of what they represent, so when you present them on the financial statements, you know why they go where they go. So, accounting changes. Now, when we have accounting changes, we have actually four things that can happen. We can have a change in accounting principle. We can have a change in estimate. We can have a change in reporting entity. And we can have an error. Remember, an error is always treated the same as a change in accounting principle. It's not the same, but it's treated the same. Now, a change in accounting principle, we're referring to a change. Remember, you're going from one acceptable accounting method to another. So if you're using an accounting method that's not covered under GAAP, then it is considered a correction of an error. All right, so what kind of changes are we going to have? Well, we can have mandated changes in accounting principles. Now, normally these are treated retrospectively, but sometimes that's not possible, so we do a modified retrospective approach, or we only look forward. The modified retrospective approach is we only change beginning retained earnings. We also have voluntary changes in accounting principles. These are always accounted for retrospectively, which means you've got to go back and correct prior years. So an example would be a change in inventory costed method. But a caveat there, it depends on what method you're going from to whether you can actually go retroactively. Now, change in depreciation, amortization, or depletion method. These are considered a change in accounting principle that we treat as a change in accounting estimate. So what does that really mean? Well, it means that we have to account for it only going forward. We cannot change what we've already done. We can only go forward. So it's treated the same way as a change in accounting estimate. However, one of the differences with a change in depreciation, amortization, or depletion methods, you must footnote it. Okay? And that is a requirement versus, and they have to justify it. Now, a change in accounting estimate, an example would be, say you're using 2% estimated accounts receivable, allowance for doubtful, and you decide, you know what, that's not high enough. This year we're going to have to go 3%. That would be a change in accounting estimate, and you would only go forward. So it's not considered an error. You don't go back and make any changes. You only go forward. If it's material, then you need to have a disclosure note. All right. Now, prior period adjustments. These are errors. Required when a material error is discovered in the statement that have been published and distributed to shareholders. Requires that the company record a journal entry that adjusts any balance sheet accounts, accounts for the income effects in the beginning retained earnings, and a disclosure note to communicate the impact of the error. So remember, it has to be material, but you have to go back and restate. And people sometimes say, well, how far do you go back? Usually you will always show 3 years on the financials, so you would go back 3 years. Now, the other thing we have is discontinued operations. This is if a company decides to sell or dispose of a component of their business. Profits from these discontinued operations will not continue. You have to do it immediately when a decision is made. An example would be if a company that makes sneakers decides we're not going to do sneakers anymore. That would be considered a discontinued operation. Now, if we have 4 different styles and we decide to go back to just 2 styles, that would not be a discontinued operation. So, a component of an entity or group of components has been sold, disposed of, or is considered held for sale. Disposal represents a strategic shift that has or will have a major effect on a company's operations. Income or loss from discontinued operation is reported separately below income from continued operations and always shown net of tax. So let's take a look at an example. Okay, my company has income before tax of $1 million, and then he has some material items. The company sold one of its operation divisions, which qualified under GAAP as a separate component. The before tax on disposal is $340,000, and the division generated before tax income for operation of $500,000. Next, the company incurred $80,000 in restructuring costs, and we have to assume the tax rate is 25%. Well, first, we have our net income before we consider them. Here's something to remember. Restructuring costs are part of income from continuing operations. This is if you decide to lay off 10% of your staff, that would be part of restructuring. That is going to be, because people do it all the time, so that would be part of, and it would be shown pre-tax. Then we take out our taxes, and now we're going to show discontinued operations. But remember, we always show them net of tax. So it would be the amount times whatever the tax rate is. In this case, it's 25%. So that's how we come up with our numbers. And now we get, in this case, we had a gain on sale, and now we have our net income. So anything before income from continuing operations is always going to be shown pre-tax. Anything after it is always going to be shown net of tax. Now, the other thing we're going to talk about is another component of the income statement, which is comprehensive income. Comprehensive income specifically identifies specific categories that are not included on as part of net income. Okay, so here's their gains or losses, and the items would include net unrealized holding gains and losses on available for sale securities. Now, net unrealized means that you haven't sold it, you just adjusted the fair market value. Gain or loss from post-retirement benefits. Deferred gain losses from derivatives, and foreign currency translation adjustments. So now let's look at an example. So net income is $6,860,000. We have the tax rate of 25%. So let's look at these items. One of the factories has closed and restructuring costs were $1.2 million. We know that that would be treated as pre-tax as part of operating income. They disposed of operation division that qualified under GAAP as a component that incurred losses of $560,000, and they sold off the assets at a gain of $1,004,000. This would be part of discontinued operations and shown net of tax. Then we had investments were sold at a loss of $220,000. In addition, there was unrealized gains of $320,000 on long-term investments. So the loss on the sale would be part of other, shown pre-tax, and the unrealized gain would be part of other comprehensive income. It was discovered that depreciation in the previous year was understated. This would be an adjustment to beginning retained earnings and treated as a prior period adjustment. Negative foreign currency translation adjustment for the year, $240,000. This would also be part of other comprehensive income, shown net of tax. So now let's take a look at what that looks like. So we'd start with our income from our operations. subtract our restructuring costs. Then we would take other, which would be a loss on sale of investments. Now we have net income from continuing operations, which is pre-tax. We take out our taxes, and now we have income from continuing operations after tax. Now we're going to adjust for discontinued operations, less the tax. That gives you net income. Now we're going to have our category called other comprehensive income. We have our unrealized gain. These are all net of tax. We have our foreign currency translation, net of tax. And we have total other comprehensive income, and that's how you get total comprehensive income. It is a combination of net income and other comprehensive income. And in some cases, you will see other comprehensive income net of tax on a separate statement. They'll show net income, and then the next page would be other comprehensive income. They do it both ways. That ends part 1. Thank you.